One guy who have a strong view on this is David Buckland, CEO at Montgomery Investment Management. David, thanks for joining us.
Pleasure, Peter.
Okay, mate, what did you think about my little rave before I introduce you? Is there any truth in that?
Oh, I think there's a certain amount of truth. So, Peter, what we saw really this financial year, so the last 9 months from the 1st of July, is we've really seen a rotation towards, I would say, generally lower quality businesses and away from higher quality businesses, a generalisation. And as you quite rightly said, there's been a rotation towards large banks, large resource stocks, and away from some of the medium and small cap companies. Now, if you define a medium small cap company as the X100, and they're usually businesses with a market cap of sub $2 billion, what we've observed so far this financial year is that probably about, of the 100 to 300, so 200 stocks, we've observed that about 35 of those stocks, about 17.5% of those 200 stocks, have actually declined by 20% or more so far this financial year. And conversely, about 52 of them, or 26% of the 200, have actually appreciated by 20% or more. So it's probably a bit too much of a generalisation just to say, you know, there's been this rotation and X has done very badly and Y has done very well. I think what's happened is that what we've observed is that stocks that haven't met expectations have been basically bashed up. And that has included some pretty high quality growth stocks. And conversely, we've also seen, as I say, a bit of a transformation into less high quality stocks, particularly some resource service companies and resource stocks have done particularly well in the last particularly 9 to 12 months.
So, David, let me give you a classic example of one case where I don't think you're right. I think you're genuinely right. But CSL, it was dumped around Donald Trump time, wasn't it? When healthcare stocks were on the nose, and it went down to how low did it go? Probably low 90s, maybe a bit lower, and then it's rebounded back to 127. So that to me was a classic case of where some fund managers wanted to take the money to pick up the miners because they were shocked that BHP and Rio should rebound the way they did. But a good quality company like that got belted up for no apparent reason.
Yes.
Is that a fair call?
Oh, that's a very fair call. So with CSL, I think there was a sort of certain amount of nervousness with respect to possibly repealing Obamacare, and interestingly enough, you know, Trump hasn't even been able to get through that his public Republican-controlled Congress. And on the other side of the coin, CSL did come out with a very, very strong announcement in January and rallied very, very hard on the back of that announcement. So I think those two factors, as you quite rightly said, you know, have seen it go from the 90 odds to the 120 odds in a very, very short period of time. So there has been, you know, a move back into that sort of high quality stuff, but it's not just been, you know, Trump or, you know, repealing of non-repealing of Obamacare. It also was on the back of a very, very strong earnings announcement in January.
Yeah. Now, David, a company that you guys have followed and always recommended, Challenger, is a classic case of a company that kept doing well, and it's not a minor, it's not a big cap, and it's certainly not a bank, but it's continued to do well, and you guys have always said that. But a company you did like that has really copped it lately, Isentia, and you know, of course, you know, Roger's always liked it, and you've liked it as well, but it really has gone through some real problems lately. How have you assessed the situation with Isentia?
Well, it's been, you know, a combination of factors. Firstly, you know, we had management selling in the sort of third quarter of last year. We had at least 2 earnings downgrades, so management credibility is on the line with 2 earnings downgrades and on the back of management selling, which is always a bad smell in you know, anywhere. And then finally, one of its competitors called Meltwater, or its main competitor called Meltwater, seemed to get the jump on it in the last 6 months, where they've picked up a handful of Isentia's clients. Now, there's no doubt in my mind that Isentia will fight back. You know, I've got the hugest respect for John Kroll, their CEO. I think they'll fight back, but the question we ask ourselves, particularly when a stock performs so appallingly, is have the long-term prospects been greatly hindered or not? Now, our assessment is that there's no doubt that there is some pressure coming on this business, and temporarily it's definitely getting beaten up. We're just not sure if the long-term prospects sort of been completely detrimentally affected. So we've actually been nibbling a bit of it with this price that's done so appallingly in the last 6 or 9 months, Peter.
But you're not going off the company totally at this point in time?
No, we've actually been adding to it at the margin with this big significant pullback.
Now, is there a company that conforms to my analysis that it was a good company, you guys liked it, it hasn't done anything all that wrong, but still the market has basically sold off, and therefore, if there is going to be a bit of a pushback from banks and miners, it's a company that could easily come back into favour over the next few months?
Well, a good example would be a company like HealthScope, which obviously is a competitor to Ramsay Health Care, and Ramsay Health Care is obviously a much bigger, more successful business, but they're in the same space. They're in private hospitals, and HealthScope has a number of greenfield operations that will be open in the next 24 or 36 months. But that was a classic case where two things occurred. Firstly, if you look at that space, their growth has typically averaged about 4% per annum in terms of patient numbers, and that's been going on for sort of 10 or 12 years. And they had quite a poor September 2016 quarter. And they simply made an announcement, which I thought was poorly couched, and that was that if the September 2016 quarter remains intact for the ensuing 9 months, their earnings growth for fiscal 17 would be negligible. Now, the stock market took that as reality and said, OK, HealthScope, we're going to punish you and push you down from approximately $3.20 to low $2 mark. The fact remains, Peter, that private hospital businesses are still a very, very important part of our lives. And with demographics, that 4% growth prospect should very much be intact for the next several years. So my view is that in the low $2 area, coming down from $3.20, that is a classic case where someone should say, hey, that's a temporary phenomenon, let's have a serious look at this situation.
So have you guys been nibbling at that,
yes,
at these low prices?
Yeah, that's right. We've actually been adding to that one. And but I should also warn viewers, Peter, that there's some information coming up from Senate inquiries on the cost of prostheses. Sorry about that. And
hard word, mate. It's a hard word.
Yeah, especially when my brother's the medico in our family, not me. But basically, what could happen is that could actually be a little bit of a negative influence in the shorter term. But longer term, we still very much like the prospects for that business.
OK, look, I've never asked you this question before, David, but this is my show and I've got you trapped there. Do you and Roger ever disagree on big order issues, like the fate of the world and the fate of China? And if so, do you ever win an argument with him?
Oh, no, we disagree on a number of things, Peter. I mean, look, China is a classic example where, it was only last January or February, it really looked like, GFC #2 was really commencing in spades. And if you remember, commodity prices in Australia were looking very ugly. The Australian dollar was back at 68 cents. And suddenly we got this very, very strong credit-induced boom from China. We saw, obviously, iron ore approximately triple. We saw oil approximately double and the like. Now, the question is that still intact? And it seems to be intact. But the question I have is, credit-induced booms don't necessarily go on forever. And we're sort of starting to pick that up with our own housing sector, particularly in some of our major eastern seaboard cities. They don't just go on forever. So, the question still remains, will that go back to some sort of normal level in China and negatively influence Australia over the longer term? So what is your macro picture? I know you guys don't necessarily place that much importance on the macro setting, but I guess if you had a choice between a booming Australia and an Australian recession, you prefer a booming Australia, wouldn't you, David? Oh, of course, Peter. Our job is to manage money, and manage money is a lot easier when you've got a tailwind than a headwind. But I will say a few things. Interest rates at the long end of the yield curve have come down from 15% globally to 1 or 2% in the last 35 years, and they are starting to tick up. We've seen them tick up by about 1% in both Australia and the US. So that tailwind of 15 down to 1 or 2 is just at the margin starting to become a headwind. US corporate profit margins, which are cyclical series since World War II, have been at recent years at all-time highs, even though they're a cyclical series. Why are they at all-time highs? Digitisation, globalisation, automation. So basically what's happening is corporates have got a lot of pressure on labour, and labour is not earning nearly as much as it used to, so corporates are doing particularly well. Now, is that going to be ongoing? The jury's out. The third thing, of course, is indebtedness. We've seen a world over the last 3 decades that have got extremely high debt. We're reading about this every day of the week now. Extremely high debt, and what that's simply done, Peter, is brought forward consumption. And that is a tailwind that can't go on forever. And then fourthly, demographics have been pretty kind in the Western world, and that's not so in the future. So you've got these 4 factors being, indebtedness, corporate profit margins, demographics, and the like, and they're just not going to be there going forward. So interest rates was the 4th one, and they're not going to be there in the future. So I just see all those very, very lovely tailwinds just at the margin starting to become slight headwinds.
And so how much cash are you guys holding?
So we're holding about 30% across the domestic portfolios and about 20% across the global portfolios, Peter.
Okay, so therefore you must be more bullish on the global than the local.
Oh, there's just so many more opportunities. Australia's 2% of the world. There are these wonderful technology platform businesses around the world that you can't get in Australia, and many of them are still, still very reasonable value.
David, thanks for joining us on the show.
My pleasure, Peter.